Hello and welcome to our latest Fund Manager Insider video. Today I have with me Noelle Cazalis from the Rathbone Ethical Bond Fund. Noelle, thank you for your time today.
Hi, thanks for having me.
As a bond manager, you consider economic and political trends as part of your investment strategy. So I was wondering how much of your time is spent analysing the impact of, say, the potential outcome of the upcoming US general election and what that will have on bond markets.
Sure. Yes, of course, we do consider political trends. I mean, it's very hard to say, how much time, and especially I think in the bond market, there's so many different moving parts. We look at political trends, we look at economics, we look at central banks policy and how they affect the market. We look at supply demand, then we look at sector dynamic, regional dynamics. And I guess there's so many things to look at. That is what makes the job interesting, but it's really difficult to dissociate every single theme. But I would say over the last couple of years, politics have definitely played a big role in what we do. I mean, we've seen in the US, obviously, the Trump election last time around, in the UK Brexit, which we're still talking about quite a lot 4 years after the vote, and the rise of populism in Europe. So there's been really much more dynamics to be aware of in terms of politics. So it's been more and more important, I would say, over the years. And of course, who is in power in a country is going to really influence their fiscal strategy, how much debt, therefore, they issue into the bond market. And that's why it's really, really important for bond investors to look at it.
And sticking with the macro, on, say, a 12-month view, what would you say are the biggest economic and political fears and risks for the bond market?
Sure. I guess right now my biggest concern is around default rates. I think, default rates have been pretty low over the last 10 years, really. But with the pandemic, I feel many businesses had to really transform themselves. Some are seeing huge disruption. If you take the transport sector, for example, most companies have seen revenue declining by over 90%. So it's okay for now, but how long can that go on for, when your company has only 10% of its previous year revenues? I think for now we have government, putting a lot of fiscal stimulus. We have central bank doing quantitative easing. So that's really supporting the market and supporting companies that need the cash to kind of keep going. But I think over the next 12 months, we're going to start to see default rates picking up, companies running out of cash effectively and not being able to service their debt. It's not so much of an issue in investment grade as in the higher quality companies, but I'm really worried about high yield and certain sectors there where, the companies have a lot more debt. So I think defaults are going to rise quicker there. So yeah, I'm really paying a lot of attention at things like liquidity position, how much cash they have in their balance sheet, and effectively how long can they go for in a really stressed scenario where consumers are at home and perhaps spending less than they used to.
So I wanted to move on to inflation. Firstly, inflation is described as a bond's worst enemy. For those unfamiliar with why that is, could you explain why that's the case?
Yeah, so inflation is a big risk for a bond investor, and really it is because it deteriorates the return associated with bonds. So if I take an example, most bonds, pay you a fixed coupon. So let's say I get a 3% coupon every year. Let's say inflation now is 2%. So every year I get 3%, which is more than inflation. So the goods that I bought last year, I can still buy this year and a little bit more because I get more than inflation, more than the price increase of my goods. But if inflation rises, let's say to 5%, I still get my 3% because the coupon is fixed. And so effectively now I can't buy the same amount of goods. So effectively my purchasing power is lower just because of that inflation risk. So effectively that's something that we need to look at, over the long term. And if inflation rises, usually what you see is that central banks hike rates, and that means that bond price decreases, and that's why as investor it is important to us.
I mean, there have been a number of commentators that have the fear that inflation is going to rise in response to the huge stimulus measures that have been made, well, across the world, but in US, UK, Europe, in response to COVID-19. What's your view? Is the prospect of higher inflation something that concerns you?
It is for sure a risk when you see that much stimulus, being pumped into the different economies. I think for now, my view is more that you have still a lot of deflationary forces, and in my view, they remain more important right now than the risk of inflation. And there will be things like demographic trends, in the economy that you mentioned. The population is aging. That's in itself deflationary. Then we've seen saving rates increase, meaning consumers are spending less, and the consumption is still fragile. We also see energy prices staying really low, with oil price being pretty low, and I don't really see oil price being increasing sharply over the next couple of years with the transition to a lower carbon economy and things like that. So I think these deflationary forces are going to mean that over the medium term inflation remain contained. But perhaps it's more of a risk, I guess, a higher inflation in the US, where consumption has been actually much more resilient than it is in the UK or Europe. I think now consumers are back to 97% of their pre-COVID spending level. So it is something that we look at carefully, and especially in the US. But it's not my biggest fear or biggest risk that I'm looking at the moment.
Finally, in terms of the thematic ideas that the fund currently has, could you run through what the biggest themes are?
Yeah, sure. So perhaps if I start with financial, we continue to see a lot of changes in capital structure, which means that as a bondholder, we can identify securities that will be called and tender. And effectively, what that means for us is that we get nice price appreciation. So we get nice performance for an asset, and that effectively is not going to continue to count as capital for banks. So we're seeing a lot of change or regulatory changes there. And that's been a big driver of performance in the last 5 years, but we expect it to remain a big driver of our performance in the next couple of years. Another theme that we look at is something called Anthropocene, which is a new geological era, where effectively the geology is dominated by human impact. And we look at a lot of different themes in that category, so things like biodiversity destruction, population growth, and therefore, and as a second degree a theme, the rise of civil unrest, the fight for resources, and things like that. So we try to avoid companies that negatively affect the consequences of that, and focus on the potential beneficiaries, such as renewable energy, such as social housing. As population grow, obviously social housing become more and more in demand. I mean, in London, you have to wait 2 years, I think, now to get a social housing flat. So, that's the kind of a theme that we always thinking of. And perhaps the third one I'd mention is the green revolution. I mean, Boris Johnson said the UK wants to be the Saudi Arabia of offshore wind. And we hear more and more comments on the green revolution from the EU. And other economies as well. So I think we're going to see more and more opportunities for us as an ethical investor in that space. Things like renewable projects, green bonds, etc., etc. So that's something we're looking at quite closely. And I would say over the last 5 years, we've already seen an increase in opportunities. But if you ask me, my view for the next 5 years, I think this market is going to continue to grow exponentially.
Noelle, thank you very much for your time today.
Thank you.